Hello friends, welcome back to part 12 in my Tesla earnings forecast video review series. I am joined by my friend and co-host, Loki. Let's see here. Can I fix... Yes. Let me fix the height on this. I don't think Loki is gonna eat his breakfast while it's in here. Sometimes people wonder, hey, when we don't see Loki eat breakfast, what happens? Well, he just eats it later. After I'm done recording videos for the day, I take his food back, and he eats his food not on the dining room table where I make my videos. Alright, so let's share my desktop, and you can keep an eye on Loki in the Loki cam down here. If he decides to eat his breakfast, I'll move the camera so you won't miss the thrilling action. Here's the last tweet that we saw, Stevenson Indicator. Let's move on down to the next tweet in the thread, tweet 20 of my 69 tweet Tesla forecast thread that I sent out on May 7th. What's this chart? Well, it shows Tesla PE compression over time based on the high, low, and quarter-ending stock prices. It may not stay this compressed very long when the bull market returns. Not financial advice, do your own research for entertainment purposes only, etc. So what am I talking about here? PE ratio, valuation. How much are you paying when you buy a stock relative to how much that company earns? So if you look at the annual earnings, the most recent annual earnings over a 12-month period is what people use a lot. You can use lots of different stuff to make a PE ratio. That's a common one. And then you just compare the stock price against that, and you say, how many times more than this company's earnings do I have to pay if I want to buy one share of their stock? It's also the ratio of the market capitalization to the earnings dollars, because that's how math works. The stock price is the market capitalization divided by the number of shares, and the EPS is the earnings dollars divided by the number of shares. So you're dividing by the same denominator in both cases. You get the same relative magnitude comparison, whichever way you do the math. Okay, people just like doing the per share stuff because it makes the math easier to do it than having to carry around billions of shares in your head for the calculation. Alright, so what do we see here? Tesla PE ratio, compression, and range, non-GAAP, fully diluted, trailing 12-month basis. So I mentioned that was one of the ways you could do it, is look at how much has this company earned over the previous 4 consecutive quarters. So that's, you don't have to worry about seasonality if you do it that way, because you're counting each quarter one time. That's what you want to do to make sure you don't have seasonality in your number. And fully diluted means it includes shares that have been earned but not yet exercised by people who get stock-based compensation, that sort of thing. So it counts those shares even if they haven't been exercised. And so this PE ratio got to its highest point on this chart back in Q4 of 2020. Not 2021. The stock price kept rising through 2021 and peaked over here. But the PE ratio was higher back in Q4 of 2020 than it has been since, interestingly. So the reddish line here, that's not really a red, but the line that's more red than any other color that's coming to mind right now is giving you the day of that quarter that had the highest stock price divided by the previous 12 months earnings. The yellow line down here is giving you the lower bound. So it's saying, okay, what was the lowest stock price during that quarter for any closing stock price in that 91-day period or whatever. Let's divide that by the previous 12 months worth of earnings and see what PE ratio it was on the day the stock price was the lowest that quarter. And then the quarter end PE isn't giving you the average during the quarter, it's giving you at the end of that quarter what was the stock price divided by the previous quarters worth of earnings. So yeah, here you go. This is what the PE ratios were in each of these quarters, and you can see the trend is Tesla getting more and more affordable relative to how much they're earning, right? Um, that happens during bear markets, which is what we had back in 2022. Multiples come down, they get compressed when the value of all equities falls. So that's what we've seen with Tesla. Tesla is a high beta stock, means that when all stocks decline, Tesla declines by more. When all stocks rise in value, or when the average of the stock market rises in value, Tesla rises by more. So it's a risk-reward playoff or trade-off for investors. And I'm going to squeeze in two more charts on this one because these are very straightforward in tweets 21 and 22. Some Tesla haters like to claim that Tesla's operating expense numbers must be fraudulent because they aren't increasing by enough. That's true. Gordon Johnson is one of the people who claims this sometimes when it benefits his argument. Mostly it's due to CEO stock compensation. There was a one-time $340 million payroll tax hit for Elon's 2012 CEO stock comp exercise in Q4 of 2021. Here's Q4 of 2021. Now, why does that not hit the CEO stock compensation line? Because it got recorded as the blue area, the SG&A excluding stock comp, because it was a payroll tax. It wasn't more stock being issued to Elon. It was Tesla having to pay their share of the taxes, the payroll taxes owed when Elon exercised options he earned under his 2012 CEO Performance Award plan. He earned those a long time ago, but then he didn't buy them until right at the end of 2021, Q4. I think they would have expired if he hadn't bought them, so he would have been working for free over that period of time if he hadn't taken his stock compensation by buying those shares at the same price Tesla was trading at when his CEO stock compensation award went into effect for 2012. All right, so pretty straightforward here. This is just a stacked bar chart of the stuff that makes up operating expenses. When people talk about Opex, what's in there? Well, research and development is. That's the base here, the lightest blue color. Then on top of that, you've got SG&A, excluding stock compensation. So you've got the money Tesla is paying. Mostly we're talking about compensation expense here. For people who don't work at a factory, right? Their work isn't directly benefiting production output. So who are we talking about? The legal team, the HR team, the finance team, security, accounting, support organization type expenses, right? Then in the dark blue, you've got SG&A stock compensation, so the portion of the compensation that's paid as stock rather than as cash. Then the green is the CEO stock compensation, so how much was Elon Musk earning towards his compensation as CEO? That's shown in green here. Now, he hasn't earned very much recently. I've got some money starting here in Q3 of 2023 for Tesla to start paying start paying Elon some Tesla stock compensation, or that he would start earning performance awards in Q3 of 2023. That's coming up very soon. That's next quarter. So we'll see if the board decides to release another compensation plan, or if I need to push this out another year. Maybe Elon will keep working for free for another year. That would be unusual. And then restructuring and other is just saying, hey, if there were layoffs and you had to pay people severance, you want to record that separately. So that's one of the things that would hit in restructuring and other. Tesla has done layoffs in certain quarters over time. Most quarters, this amount is zero. Some quarters, it's more expense than that. And you can see my forecast here, beginning with Q2 of 2023. This is the first forecast to go quarter. You can tell by looking at the labels down here at the bottom. These are all the actuals over here, and this is my forecast. I've just got it continuing to rise as we've seen it rise over the past 5 years. All right, so that's that one. And then the next one is just the SG&A portion of that. If you throw out the research and development and the restructuring and other, the chart looks like this, a little bit smoother. You can see this one does stick out, that Q4 2021, when there was an extra $340 million worth of one-time payroll expense associated with those very old stock compensation awards Elon exercised during that quarter, and then Tesla had to pay taxes on. So in Q4 of 2022, that was when we saw Gordon Johnson say it's fraud because it came down. He thought it was fraud because he hadn't done the research to find out what the components of SG&A are, which is very easy to do if you just bother to look, to do some research. And that is my video for today. So we'll check back in with Loki, who is trying to sleep some more, I guess. And I'll say if you enjoyed today's video, don't forget to click the like button. If you're interested in supporting me, you can find info about that in the video description on YouTube. And thank you to everyone who supports me, especially my executive producers, Kathy Kitchler and Rebellionaire.com. And I'll see you in the next one.